There is one ultra famous investor who recently steps down from his role after 55 years, who's a big advocate for index funds. Can you guess who it is? That's right, Warren Buffett. He is a huge fan of index funds and he often advises investors to invest in index funds regardless of market conditions, i.e., whether markets are going higher or whether they're declining. Because in the long run, markets trend higher, which means that your investments will see an increase over time as well. If you are only looking to partake in the performance of the market, then an index fund is a great way to go. It follows a passive investment strategy, which means that it's not trying to beat the market, it just matches it. Number two is a diversified portfolio. The second thing about index funds is that you get the advantage of safety in numbers, because you don't have to know or be an expert at picking stocks. By buying an index fund, you automatically get access to widely diversified stocks that cover different industries as well as sectors. And so if you're not interested in researching tens or hundreds of stocks, an index fund offers built-in diversification. And this diversification is fantastic because although not all stocks rise over time, the overall market tends to trend upwards over the long term. The second way to invest your $1,000 is to invest through an ETF, an exchange traded fund. Now, these are very similar to index funds. Just like index funds, they track an underlying index. But the main difference between the two is how they are traded. Index funds trade once daily at the net asset value, i.e., the price of an index fund is based on the total value of securities within the fund. Whereas with ETFs, they trade throughout the day. You can buy and sell at any time you want throughout the day because they trade like normal stocks. You can also buy as little as 1 unit of an ETF, often with no minimums. But some index funds may have a higher minimum investment amount, like $500 or $1,000. And so just like an index fund, an ETF gives you access to hundreds, maybe even thousands of stocks under one instrument. Some people prefer the flexibility of ETFs over index funds, and this is because they enjoy the ability to trade in and out of their positions at any time of the day. And just like index funds, ETFs are typically passively managed, although you can get actively managed ETFs, which means that the fund managers will make active investment decisions based on market conditions or where they see dislocations or opportunities within the market.